I want to start by thinking about tax in general and then focusing on indirect tax. And partly that's because the approach that we're taking in this phase 2 work is very different from phase 1. In phase 1, we put together a 20-page questionnaire which described these 4 Islamic finance transactions, commodity murabaha, salam, istisna and sukuk, in great detail, step by step, and then asked 68 tax-related questions on how this transaction will be treated in your country, whether it's Libya or Turkey, whatever. The approach that we're taking in phase 2 is very different. It's basically going to be desk research, whereby we clearly will look a bit at the outside world. For example, I'm quite interested in looking at how the UAE is planning to treat Islamic finance and VAT, because they're bringing in a VAT law in the UAE. I want to look at Singapore and how they treat conventional financial services and VAT. So there are various things we are going to look at in quite a lot of detail, but ultimately the report will then consist of proposing what we, the authors, will think of as good practice. That I'm the lead researcher, but my fellow researchers, there's a chap based in Washington at the International Tax and Investment Center, there's another chap based at the Qatar Tax Authority, but obviously working in a private capacity on this rather than representing the official position of the Qatar government. So let's think about the theory. Starting off with the most fundamental questions about, what are taxes for? What makes a good tax? What kinds of taxes are there? And then we will home in on consumption taxes, and in particular spend quite a lot of time looking at VAT. And the coverage tonight is all theoretical. Once you get down to practical reality in terms of trying to change the law, you hit all kinds of implementation issues, of which the biggest, as far as the UK is concerned, is that on VAT, the UK has no independent ability to change VAT law. VAT is a harmonized European tax, governed most importantly by the 6th directive, but the only way to change the fundamentals of the VAT system is for the countries of Europe to agree to change it. No country can change unilaterally. I don't have to worry about that because I'm talking entirely at a theoretical level. So what's a good tax? Well, Adam Smith said it all in The Wealth of Nations a couple of hundred years ago, and he laid down 4 criteria about equity, neutrality, certainty and administrative efficiency. I'm not going to talk at all tonight about the first 3 of those, but you will see that administrative efficiency comes up every so often when considering different kinds of tax and how they might work. What can you tax? We're all used to income tax, capital gains tax. Consumption taxes are an interesting issue. I'm not aware of any consumption tax anywhere in the world that is a genuine tax on consumption. Consumption taxes work by taxing you when you spend money on buying something that you might consume later on. Wealth taxes, we used to have a tax in the UK that we abolished in 1961 called Schedule A, which was a tax on the imputed income from owning a house. And transaction taxes, real estate transfer tax and other transfer taxes. So let's look at transfer taxes, because now we start to see where it starts to matter for Islamic finance. And in fact, the very first change in its own tax law that the UK made for Islamic finance was in relation to our real estate transfer tax, called stamp duty at that time, and now called stamp duty land tax. And what I've done here is draw a very simple sukuk structure, where you have a company that owns some real estate and wants to raise finance. And what it does is that, with the help of its investment bank, it sets up a special purpose vehicle, a company which itself is owned by a charity, so the company is not part of the owner's group. It sells the building to that SPV. How does the SPV pay for that building? it issues pieces of paper, sukuk, to investors and gets in the subscription price, and it pays that to the owner to buy the building. As soon as the SPV owns the building, it rents it back to the owner, who will pay rent to the building, say for 5 years. These pieces of paper, the sukuk, that have been issued to the investors, are technically ownership rights over the assets of the SPV, which means ownership rights over the building. And since the SPV is receiving that rent, it's receiving it on behalf of the sukuk holders, the investors, so it passes the money over to the investors. And at the end of the period, when the 5 years are up, the owner will buy that building from the SPV, and the SPV will pass that money over to the investors because it's their building. So you've got 3 transactions in land. You've got the original sale by the owner to the SPV. You've got the renting of the building, and in many jurisdictions, including the UK, renting a piece of real estate itself is a transaction in land. And then finally, you've got the sale by the SPV back to the owner. And if all 3 of those real estate transactions are subject to stamp duty land tax, that is a crippling penalty which will make the transaction completely unfeasible. When you bear in mind that for a conventional loan secured on that building, if the owner had issued conventional bonds secured on the building, there would be no land transactions and no stamp duty land tax of any kind. The UK has changed its tax law to eliminate all 3 instances of stamp duty land tax for the transactions on this slide. And it did that in 2009. Similarly, if you go around the world, other jurisdictions have, in many cases, changed their taxation of real estate transfers to facilitate Islamic finance transactions. So, for example, in the state of Victoria in Australia, if you sell a house to a bank, or a bank buys a house from a third party, then supplies it to you on an Islamic mortgage, which means that the house eventually changes ownership twice, they've got law in Victoria to ensure that only one Victoria stamp duty charge arises, exactly the same as if you bought a house directly. But you need to look country by country, jurisdiction by jurisdiction, to see how real estate transfer tax is treated for VAT, for Islamic finance purposes. Both Malaysia is one country I've looked at in quite a lot of detail, because, being blunt about it, the Malaysians have done more thinking about Islamic finance than any other country, except now with the possible exception of the UK, which has also thought very deeply about Islamic finance. But it was the Malaysians, for example, that invented sukuk. And one of the things that our Phase 1 report brings out is the way that both Malaysia and the UK have been able to make their tax law fit Islamic finance, but taking completely different philosophical approaches. Very briefly, Malaysia has a central Sharia authority for Islamic finance transactions. It's the Sharia board of the central bank. They're able to specify what counts as Islamic finance, specify particular transaction structures, and if a bank does one of those transaction structures, then a series of favourable tax rules apply. The UK, being a country that wants to keep religion out of its tax law, takes a completely different approach of describing certain kinds of transactions, for example, the issue of what's called investment bonds, which matches a sukuk, but in completely religion-neutral language. But both get to the right answer, which is to avoid treating Islamic finance worse for tax purposes than conventional finance is treated. So let's move on now to consumption taxes, which is the main subject tonight. And again, consumption taxes fall into 2 categories, sales tax and value-added tax. And you may ask, what's the difference, given that value-added tax is also charged on sales, and both of them are taxes on consumption. But there are fundamentally different design issues in these two kinds of taxes, which are often obscured by people getting too immersed in the detail. And what I want to do today is to look very much at the big picture level in terms of these design issues. So sales taxes. The normal thing for sales tax is that you charge the tax when something is sold. So if you imagine a business that makes something, it makes, for example, tins of beans in vast quantities, or paper in vast quantities. It doesn't normally sell to end users, it will sell to another business. You charge sales tax. And that business sells it to a smaller business, which charges sales tax. And then that smaller business, think of a corner shop, which has now bought paper in sort of manageable quantities, and it sells it to you, the end consumer. That's a sale, and tax on there. So at each stage in the chain, some tax is being charged, and of course that tax is compounding. So if the first item, the first sale was at a price of £1, and let's say sales tax is at 5%. That means that the second business has bought that for £1.05. And when it sells it to the third business at some higher price, allowing for a profit margin, it will charge that 5% not only on the original goods, but of course it's 5% on top of the 5% that was built into the price from the first sale. So it just compounds. The more stages of the chain you've got, the more tax gets suffered, which can feel unfair. If the tax is at a relatively small rate, you may not mind too much, but if the tax is at a substantial rate, like 5%, that's an awful lot of cascading. You could charge the tax only on the last sale, the sale to the final consumer. And that might feel a great deal fairer. In some ways it would be. There's one practical problem though, and that is compliance risk. Because these three businesses that I've outlined are in practice in reducing order of size. You've got a very big business at the far left, which is making the things, and a small business like a corner shop at the end, which is selling things to the final consumer. And yet all of the compliance responsibility for collecting sales tax is on the smallest business, which is the business that is most likely to falsify its results and has the greatest opportunity to falsify its results because it's selling to the end consumer for cash. Whereas these earlier sales in the chain, which are bulk sales, will be sales for checks, sales for electronic bank payments, which are much harder to falsify and hide. And there's no easy solution to that with the design of sales taxes. And it's not the only reason why countries get rid of sales taxes, but this is a reason why, if you look around the world, sales taxes are slowly becoming less popular and value-added taxes are becoming more popular. So let's go on to value-added tax. Value-added tax is also a consumption tax, but it's designed to be borne only by the final consumer. Also, very neatly, you don't charge foreign consumers. So it becomes a kind of export rebate. It's a way of incentivizing people overseas to buy your goods by not charging them tax. Whereas if you go back to the sales tax, a sales tax has been borne along this chain. If one of these companies partway down the chain exports the goods, there isn't often an easy mechanism for getting back the sales tax that was built into the price of the goods. And crucially, value-added tax is charged at each stage of the value chain, which minimizes the compliance risk, but it does that in a way that avoids compounding, which is what you get with traditional sales taxes. So let's look at a hypothetical example where we've got two stages in the chain and then a sale to the final consumer. So we've got a mining business that is digging things out of the ground, and it's digging things out of its own mine. It owns the land that is being mined. And therefore, in theory, the raw materials being dug out of the earth are free. Yes, they bought the land at some stage, but how you attribute the cost of the land to individual bits of copper that you might be digging out, leave that to the accountants. Conceptually, it's free. It incurs costs in the form of wages, and of course it wants to make a profit. And I haven't distinguished between wages and profits, because in economic terms, both of those are part of the same thing, added value. So this mining business sells things for 100. So an economist would say, you've sold something for 100, it cost you nothing, because you found it free in the ground, so you have added value of 100. And that 100 is made up partly of wages paid to human beings and partly of profits. And both of those are components of value added. The sale is to a manufacturing business, which will spend some more money on wages and make some more profits. And the manufacturing business will sell it to the final consumer for 150. And you'll see I don't really care how much is wages and how much is profits, because both of those are components of value added. So the tax system doesn't care. So that's the transactions, and now let's look at how they work for value-added tax. And of course, VAT experts will be completely familiar with this, but non-VAT experts may not really have thought in detail about the process and the chain. So let's look at the miner. The miner has dug things out for free, he sells them for 100, it will be charged, it will have to charge value-added tax on that sale. And let's assume a rate of 20%. There's a tax of 20, which the mining business has to pay to the government. It gets that 20 from its customer. So it sells something to the customer for 100 plus 20. The customer, the manufacturing business, has to pay 120 to the mining business. The mining business keeps 100, uses that to pay wages and profits, and pays 20 over to the government. Now let's look at the manufacturer. It's buying something for 100, it's paying out 120, but that 20 that it's paid is a tax. Its true cost of buying the stuff is 100, and it's selling it for 150. So it's adding value of 50. It charges 20% VAT on its sale. So it charges the final consumer 30 of tax and 150 of sales price. In total, it charges the end consumer 180. However, it doesn't pay 30 to the government. It's already paid 20 to the mining business on its purchase. So it pays the net of tax 10 to the tax authority. In total, the tax authority has now received 30, 20 from the mining company, 10 from the manufacturing company. That equals the value added tax on the sale to the final consumer, which is the only sale that gives rise to real tax. The transaction between the mining company and the manufacturing company, yes, tax is paid, but it's not a real cost to anybody. It's just accounting, but not just accounting, it's also helping to minimize the compliance risk, because tax is being paid to the government at each stage of the transaction, rather than leaving all the tax collection to the last stage of the chain, which is where the greatest compliance risk would be. And this is why value-added taxes are becoming so popular around the world, and why country after country changes from having traditional sales taxes to value-added tax. And I don't claim to do predictions, but I will give you a guess. And I think the last country in the world that will adopt value-added tax is the USA, because they are the most primitive about everything. They'd also be the last country in the world that measures things in pounds and pounds and gallons. So that's the background. Now let's move on to financial services. Because what I've been describing so far has been goods, rather than services. But exactly the same principle applies in services. If you're delivering services, and you may have a chain of services being delivered by one party to another, ultimately it's only the final consumer of those services that bears tax, but at each stage, value-added tax is collected and paid to the government to reduce the compliance risk. There are two conceptual approaches to financial services and VAT. And I've described them as follows. One of them is to say their service is a service. Every service should suffer VAT. Why distinguish any particular kinds of services and call them special? So you charge VAT on financial services in exactly the same way that you charge VAT on any other kind of service. The alternative way, or alternative approach, is to say that financial services are special and different. And therefore we will have special and different VAT rules for financial services. And that just makes life more complex, but it's just quite common. And I'm not saying that any one method is right and other methods are wrong. So let's look at this one first, where you take the approach that all services are the same. VAT is a financial services, therefore will suffer VAT just like any others. And let's look at the process of putting money into a bank, which then lends the money to another bank, which then lends that money to a customer, a borrower. Very, very common transaction, because quite apart from transactions between human beings and banks, there are enormous lending and borrowing transactions between banks. Each of these transactions, each of these loans, is a financial service. It's the supply of money in return for a payment, because I'm assuming that all of these loans are interest-bearing. So loan 1 and loan 2 will definitely suffer. Loan 3 and loan 2 will definitely suffer value-added tax, because in each case a business, namely Bank A or Bank B, is supplying a financial service to somebody else. It doesn't matter whether that somebody else is a business or an end consumer. Oddly enough, loan 1 will not suffer VAT in this conceptual model, because the first depositor, I'm assuming, is not in business. If the first depositor was a company or indeed a large individual business that was registered for VAT, and therefore in business, that first loan would also suffer VAT. So that's one way of looking at financial services. The alternative way is to treat them as special. And there are various ways of treating them as special. And there's some vocabulary that's developed in VAT which it's worth sticking with just because it is so standard. So the financial service might be exempt, which means that no VAT is charged on that financial service, but the person supplying the financial service cannot recover VAT on its own costs that arise in relation to delivering the financial service. And that's the situation right now in the UK with financial services that are delivered to people in the UK, or in fact delivered to people anywhere in the European Union. UK banks do not charge you VAT when they lend you money and charge you interest, but as a consequence, they are not able to recover VAT on enormous costs in the form of buildings, electricity, paper, computer systems, etc. Alternatively, the financial service may be zero-rated, which means that no VAT is charged, but the supplier, the bank, can recover VAT on its costs. And there are various other possibilities. For example, the reason I mentioned Singapore is that I've heard, so don't quote me on this because I'm not sure if it's true or not yet until I've checked, but in Singapore, financial services delivered to businesses are treated as taxable, but financial services delivered to consumers are treated as non-taxable. Or it might be the other way around now. I'll find out for certain once I've looked at the Singapore VAT rules. Now moving on to Islamic finance. Islamic finance makes things much more complicated because the legal form of a transaction can differ dramatically from the economic substance of the transaction. And I always like to use commodity murabaha as an example. What we've got here is a commodity murabaha transaction where the customer is effectively getting £100 of money from the bank. But the transaction is not done as an interest-bearing loan. Instead, the bank buys £100 worth of copper, say, from a commodity seller, sells it to the customer for 105, payable in 12 months' time, and the customer then sells that copper to another third party for 100, which is its value today, and gets 100 of cash. And in a year's time, pays 105, the purchase price that it owes to the bank. That's the transaction. And how does this transaction work for VAT purposes? The first transaction, the sale by the commodity seller to the bank. Sale for 100. How should the tax authority deal with that transaction? The safe approach is to charge VAT. I mean, if you treated this as an exempt transaction on the grounds that it's part of an overall Islamic finance transaction equivalent to a loan, and said that financial services are exempt, which they are in the UK, so we'll treat this as exempt, you've got all kinds of risks for the tax authorities. For a start, it doesn't know at this stage that this is going to be an Islamic finance transaction. Similarly, the sale by the bank to the customer. What do you charge VAT on? And if you don't charge VAT, are you creating some kind of compliance risk? Is the customer a final consumer, or is it going to sell this thing on to somebody else? And the same kind of issues when the customer sells the commodity to the commodity buyer. Let's assume the customer is not in business. In that case, it's got no mechanism for charging VAT, but it's probably paid VAT on this sale from the bank. So suddenly you've got a massive sticking cost of VAT. And that problem doesn't go away in the UK. The UK can't resolve this problem unilaterally. We do have a working practice in the UK that the markup isn't subject to VAT. That still leaves the original 100, which is subject to VAT, but the customer can't get it back. So if the customer isn't in business, there's a massive VAT cost in Islamic finance compared with conventional finance. How can you resolve this? These are literally off-the-wall ideas at the moment, although hopefully by the time we come around to writing our final report, we will have field-tested these ideas with my colleagues, maybe bounce them off a few tax administrators, see what they think of them in terms of practicality. But at the moment, these are just pie-in-the-sky ideas. And, well, actually, the first one is not that pie-in-the-sky because it builds very much on UK practice. So the first one is commodities with a special VAT regime. People who practice VAT in this room already will know that we have rules for stuff that's in bonded warehouses. And what's in a bonded warehouse, provided it stays there, can be bought and sold without any VAT at all. And I used to think that was a really neat scheme until I discovered that the UK bonded warehouse scheme doesn't apply to purchases by private individuals who are treated as if they were final consumers rather than businesses. If the regime applied to non-business persons as well, then essentially you've got a solution, because that commodity murabaha transaction, provided the copper stays in the bonded warehouse all the time, all three of those sales are not subject to VAT. This one is an idea that I've invented, which might be feasible in the days of electronics, although in the days of paper it would have been a complete and utter nightmare. That is this. At each stage of this transaction, the bank, which I'm assuming that the government can trust, I don't know whether you can trust banks these days given all the bad press they've had and all the criminal offences they keep confessing to, but essentially, if you can trust the bank issues certificates to the commodity seller, to the customer, that these are part of an Islamic finance transaction. And the customer, at each stage then, the person who receives this certificate is authorized to carry out the sale without any VAT being charged. And all the certificates are electronically delivered to the tax authority, which is able to match them out and see that, yes, there's a full 3-part step sale, so that nothing is going astray. And as a consequence, the copper is able to go all the way around the chain without suffering any VAT, but without the opportunity to disappear, or for somebody to do a runner without charging VAT, because all the parties are named on the certificate, they have identification, addresses, etc. And it can never be done on paper, but I think it could be done in the days of electronics. And then the final one would be to allow the end consumer to charge VAT as a special one-off if they're involved in an Islamic finance transaction. But even that raises challenges in terms of the process. How do you register that consumer for VAT purposes? Are you creating a compliance risk? Because that consumer would always be in a repayment position. It's buying something for 105, on which it would be paying VAT. It would then be selling it for 100, on which it would charge VAT. So net, it will have a VAT repayment. And yet that person, the consumer, is the least reliable part of the chain. It's a human being who might always disappear on you. And we've seen with things like carousel fraud, with high-value goods going around in chains and then parties disappearing, how easy it is for governments to lose billions of pounds of tax to criminals. So no easy solutions, but these are the kinds of issues that I'm grappling with. If anybody's got any bright ideas, you can always email me. I'm quite easy to email via my website on the Contact Me page, and appreciate any thoughts or questions now. And I'm finished exactly on time. I'm 3 seconds over.